My name is Dean Splendorio, and for my Economic Senior Seminar research paper, I will be focusing on the effects of COVID-19 on the global oil market as we bridge the gap between fossil fuels and clean energy. It is important to have an understanding of oil future markets. They were created in the 70s, but after the Nixon Energy and Conservation Act of 1975, there was less control by oil makers on the price of oil, and this led to market manipulation, and by 1983, crude oil contracts were the most expensive commodity in the world. Airlines use oil future contracts to get their finances in line because they can purchase the price of oil at a certain price per barrel months in advance, and regardless of what the price may be at the time of the contract, they can still get it at that price. Oil industries do this as well, and they also use a hedging strategy where they purchase put contracts in the event that the price of oil were to go down. This could be used as a form of insurance. An important formula to understand is energy return on investment, which is energy output divided by energy input. Research began for this on gasoline and oil in the early 70s, but after concern around global warming, research began on alternative energy such as solar, wind, fusion, and gasoline. Gasoline currently has an energy return of investment greater than 1, and there are no alternative sources that are close to that. But what we've seen in the past 10 years, and since global warming became more of a concern in the early 2000s, is that the gap between these alternatives and gasoline are becoming much closer. And as we head forward, you're going to see this gap start to get closer, and eventually we'll have a real alternative for gasoline, but it's going to take time to get there. There are many factors that affect crude oil prices. Some of the ones that have affected oil over the course of the COVID-19 pandemic are the stock market, economic development, political events, relative policies created by OPEC, which was a cartel founded in the 1960s that creates price strategies for oil, and there are also several supply and demand factors that can outweigh any of these. Over the course of the last year, the price of crude oil sank to historic levels. This all started when there was airline travel restrictions put forward by Italy when the COVID-19 pandemic first broke out. In addition to that, there was several stay-at-home orders created in the United States and other countries across the world. And when you compile that with an increase in rising infections, there was virtually no demand for oil across the world. I mentioned that the stock market can impact the price of crude oil, but the price of crude oil can also impact the stock market as well. If you look at the chart, you can see when the crude oil is in blue, you can see that first dip that occurred in January, and then a month later was when the stock market crashed due to the COVID-19 pandemic, and many economists said that this could have been seen due to the drastic fall off in crude oil prices that occurred a month before. The Organization of Petroleum Export Countries had put restrictions on oil output and production, but during the pandemic, Saudi Arabia was not compliant of this and flooded the market with additional oil, which sent oil to historic low levels that hadn't been seen in over 20 years. and it had reached a point where President Trump had to threaten the Crown Prince of Saudi Arabia to remove U.S. military protection. And on April 9th, oil production was cut by 9.7 million barrels per day. And it's important to note that Saudi Arabia was taking a serious loss in this because their break-even price for crude oil is $55 a barrel. And there's only 2 U.S. shale companies that have a West Texas Intermediate break-even price of $30 a barrel. $30 a barrel is also a crucial benchmark for crude oil because whenever crude oil falls below that level, there's serious political and economic tailwinds that follow. Some policy solutions that I have come up with would be increasing carbon capture for any company and all industries that contribute to CO2 pollution in the atmosphere. Also, I would like to see an energy return on investment for these alternative sources become closer, and if that requires additional funding, then it will be needed. And I think that fusion could be the best solution long term, even though that's the one that we're the furthest away from. We need to start funding that, and we need to stop greenwashing because several oil companies are saying that they are doing more for the environment than they really are. And until we stop that from happening, they're going to keep polluting the environment.